Good morning, everybody. It's Wednesday, October 13th. Just going to run through a few charts here. Here we've got the Kiko gold overlay chart. Yesterday, the previous day, we had seen gold stair step its way down and then have a comeback and pretty much flatline for the rest of the trading session. Yesterday, we started to see a similar price action, and it ended up pretty much just staying within the previous day's range. It did squeeze up a little bit last night, and now it's sitting above that support, and it's just kind of trading sideways here. Usually this is a time in the morning when we do see either a push up or a push down. Right around 11 or 8:30 in the morning is usually when we get some action, so it'll be interesting to see what happens here. But let me just pull up the daily chart of gold. Here's the daily chart of gold. Of course, it's been on this never-ending kind of climb here. We did have that reversal candle, but now it's starting to consolidate, and it's drifting up. It's forming a little bit of a wedge here. If we just kind of draw this here, it's going to be forming a bullish wedge, and that usually continues to the upside. We're going to see how that plays out. The volume is declining as the price is drifting back up to this high. So there is a rising chance of it breaking down, but with looking at if we were to throw a 5-period moving average on here, it's trading right up underneath these candles, and we'll see what happens today, but might actually just take a small stab at it and take a small long position, because if it does break out, we're going to see gold continue to grind its way higher, and this big reversal, this kind of pattern here, will be enough to re-energize the gold for another pretty good move up, I think. Now, and the reason I'm feeling that way is simply because yesterday we had the FOMC minutes, and the Feds were talking about continued quantitative easing, and of course if they just keep printing, it's going to put more it's going to keep boosting the gold prices, and that's going to devalue the dollar. So that's what I see there. Let me just see if I can throw a 5-period moving average on here real quick. Okay, so there's a 5-period moving average. You can see how it's just trailing right up underneath here, and it allows me to just put it. If we were to have a close below that 5-period moving average, then I would probably get out of the position, and it makes the risk extremely small to take a long position. So that's what I'm kind of looking at today. Not sure if I'll do that or not. I just want to see what happens here between 8:30 and probably about 10 this morning, and then go from there. But that's what I'm thinking for gold. Now, if we take a look at the SP 500, here's the futures. This is the daily chart. You can see I've got a bunch of moving averages on here. These are you can see them listed down here: the 5, 10, 14, 20, and 50. The 5 usually acts as a pretty good support for a lot of different investments, whether it's stocks or ETFs or commodities. Anyways, this morning we're seeing a continued move up, and that's because we're seeing the dollar drop through the night because of the quantitative easing that the Feds are talking about doing still. So anyways, what I'm looking for here is more of a pullback. It just continues to drift a little bit higher and higher each day, which makes it very tough to want to try and get in. And really, I'm waiting for another pullback down into these averages now that the market is pretty much just kind of running away here, and I want to get it on some type of pullback, and we'll have some stops set down here. Unfortunately, every pullback that we get happens in the middle of the night, and we're not around to really pick it up down at these key moving averages down here, the 10-period. So until we kind of have that happen during regular trading hours, it's going to be a little tougher to get in. But I do like the markets to the long side, and it is very long in the teeth, same as gold. But if the Feds are going to keep doing what they're doing, this could just continue to run up and just keep going for at least another month anyway. So that's what I'm thinking there. Now, if I just pull up the US dollar, you can see yesterday, the past couple of days, we've seen this nice run up. Yesterday we started to see they came out with the quantitative easing, and pretty much as soon as they set it at 2 o'clock, we saw the dollar drop down here. That really helped. Didn't do a whole lot for gold, but it helped the equities market. Kind of took a pause for a little bit, and last night it just continued to kind of slide and give way. Now it's forming a little bit of a bearish wedge. Looks like it's going to go back down, and we could have a test of a triple bottom here, and we'll see what it does today. But this is one of the reasons why I also kind of like the gold play, simply because the risk is really low, and if we break this support level, we're going to most likely see the dollar take a pretty good tumble, and that'll send gold higher and equities higher. So that's what I'm looking at there. Now yesterday I did mention there that I had a small buy signal for the market in the morning, except for the FOMC news was coming out, and I didn't really want to get in front of it because who knows what they were going to do, and it causes some pretty wild whipsaws. But this chart here is the SP 500 10-minute chart, so this is the past 2 days. This here from this line is yesterday. Anyways, we had some pretty good selling in the morning. The put-call ratio went extremely bullish. Everybody was trading puts, which means the market's getting fearful, and usually it goes the opposite direction. Anyways, this chart here, this green line indicates panic selling, and there was a lot of selling yesterday morning, a pretty good level. And usually when that spikes up, I want to look to buy in an uptrend, because that just means there's people unloading their positions, taking some profits, and some people are getting scared and just panicking out, and that's when we want to be looking to buy. So this is one of the indicators that was telling me that it would have been nice to take a small short position. It's too bad we had the FOMC news yesterday. I didn't want to get in front of it. But if we take a look at this is the put call ratio. Yesterday morning we had the put call ratio spike way up over 1. It went to 1 point. At one point it was at 1.36 on a shorter term time frame. But it was way up there, indicating anything above the green line is indicating that the market's overdone, and we should be looking to buy the dips in an uptrend. So that was giving me a good signal as well. And this here is the NYSE advanced decline line. This one also showed the market was oversold, and anything beyond the green line, of course, is telling us that we should be looking to buy on the dip. Anyway, so we had 3 things line up yesterday. Unfortunately, I didn't pull the trigger because of the FOMC. Anything could have really happened there, and it usually seems to be pretty severe. So I didn't want us to get any money in and get shaken a couple hours later. But this is what we're looking for: all these things to line up in an uptrend. And right now, if we just take a quick look, we can see we're starting to get the market a little bit. Yesterday it closed up near the red line, just saying that. Indicating that we're a little bit overdone. On the upside, might need a little breather. The put call ratio is showing everybody was extremely bullish into the close, so we might see a little bit of a pause today. And of course we had some more or less I call it panic buying, and what it is people chasing prices up, and it just forces the prices up. And when you get everybody chasing, it's usually the last, pretty much near the end of the move on a short-term basis, intraday basis. But because everything's lining up, we're getting some follow through this morning, which is why we're seeing the SP 500 up this morning a little bit pre-market, and it probably will gap a little higher. Probably it's going to gap about 0.75% higher, which is a pretty good gap. But anyways, that's what I'm seeing there, and I'll talk to you guys in a little bit. Bye bye.